Good afternoon, and thank you for joining us for today's webinar, Payments, Regulations, Help or Hindrance, which is brought to you by Payments Innovation Forum and Fscom. My name is Diane Brocklebank, and I'm joined today by David Norton, a Senior Manager with Fscom. Before I hand you over to David, I just wanted to give you some further details about today's webinar, which will run for approximately 60 minutes. If you have any questions, please use the Q&A tool on your screen, and we will try to answer as many as we can at the end.
Good afternoon, everyone. And as Diane says, welcome to today's webinar. Today's webinar is Help or Hindrance for Regulations. Interesting topic, some might say, I'm sure you would all agree. But when we typically ask organisations what their approach to regulation is, and possibly more important, do they see the benefits of a fully functional regulatory framework? The answers are as varied as there are payment organisations and products. So today we're going to try to lay out considerations when it comes to approaching the current book of regulations, and perhaps encouraging organisations in their decision-making to become more inclined to embrace new regulations and the demands which they place on your company and the industry in general. But first, we're going to ask you to consider just how your organisation approaches the announcement of a new regulation. If you were to sum up in a phrase what the prevailing reaction to announcements of new regulations within your firm, which of these or combination of these reactions would they be? From the wildly enthusiastic of great, how do we get involved in consultation, to the realist of, oh no, we've only just got the grips with the last one, to trepidation, how's it going to affect our business and our customers, or this is going to really stretch resources, and possibly the last one, to being in denial, I didn't get the memo. So there's no right or wrong answers, well, maybe possibly the last one, but I hope this webinar that we're going to go through will allow you to approach regulation in a different way, in a constructive way, through not only considering legal ramifications and resources, but also a studied approach to the spirit and objectives of regulation, which will benefit, hopefully, your firm. So we'll begin by looking at current hot topics as far as UK regulation is concerned. We'll then look at some of the benefits of regulation in terms of the firm, your clients and the wider market are concerned. Then what demands does the regulations place on your business, thinking them through, and why advanced planning is key. What's the price of failure? And we'll also look at potential questions which any significant regulation would have your firm consider and answer. What we'd really like to do is at the end of the webinar is leave you with key takeaways when it comes to regulation. In a nutshell, how can embracing regulation help our bottom line, or at least avoid any nasty outcomes to the bottom line? Or the importance of adoption of a framework of compliance, not just within second line, but throughout your organization, this idea of a whole organizational approach to regulation. And I know personally from working with new firms that the pressure is on to go straight to the money whenever you first get the application in. But how can thinking about regulation signpost priorities and help guide you to efficiency and risk management, even in the early stages? We'll also look at what firms can do to future-proof their business amid the growing expectations of regulators. So when it comes to looking at key regulations, we're certainly not going to be able to cover every single piece of regulation that's currently on the board, but what we thought we'd do is give a flavour of the key regulations that are out there. The first one, I'm sure you're only too well aware of what's occupying your board and firm's focus as far as regulation is concerned for 2023. But the big one for that is consumer duty, which is due for implementation at the end of July, but almost certainly the refinement and ongoing work and review and all of the good stuff that comes after that will last well throughout the rest of the year and probably into next. But as well as that, also not to be forgotten is the current testing and review cycles, which should currently be underway for operational resilience. As you know, or most of you will be aware, the self-assessment document that the FCA certainly called for was due to be completed March last year. But now you should be well into the stages of testing your impact tolerances, testing your important business services, and really putting a framework together which should be, as the regulator would say, part of the DNA of a company. But you should be well into the cycle of testing and verification. The recent FCA Dear CEO letter in March laid out further priorities as well in respect of existing regulation, particularly around the old favourites of safeguarding and wind down planning, another general requirement for risk management and governance.
And it's been 3 years since changes to the government's money laundering regulations came into force, as well as ensuring compliance with the MLRs. Firms are needing to keep a very watchful eye on the UK's renewed approach to tackling and preventing financial crime. To put that into some context, in 2022, over £1.2 billion was stolen by criminals through fraud. And according to UK Finance, that's £2,300 every single second. Last month, as I'm sure many of you will have seen, the government published the UK's National Fraud Strategy, which sets out a raft of measures to tackle fraudsters head on. And the aim is that fraud will be cut by 10% by 2025. You will already be very familiar with some of the current rules and regulations in place to help prevent fraud, such as strong customer authentication, confirmation of payee, but we can expect further initiatives to stop fraudsters from exploiting the ease of making payments. Among these are plans to use new legislation and regulations to ensure that more victims of authorised push payment scams get their money back. Last year, the government signalled that it would legislate to allow the payment systems regulator to require reimbursement in all but exceptional cases by all regulated payment service providers. So this will be achieved by the Financial Services and Markets Bill, which is currently making its way through Parliament. And last week, again, I'm sure you will have seen the PSR publish their policy statement setting out that new requirement for reimbursing victims of app fraud within the faster payment system. It will apply to all payment service providers in scope of the policy, and that includes smaller payment firms. So what does this mean? Well, it introduces consistent minimum standards to reimburse victims of app fraud, and the requirement is underpinned by several key policies. Essentially, it will require payment firms to reimburse in-scope customers who fall victim to app fraud in most cases, share the cost of reimbursing victims 50-50 between sending and receiving payment firms, and provide additional protections for vulnerable customers. So this new requirement comes into force in 2024. We understand that the PSR will consult on a specific start date alongside the draft legal instruments in Q3 this year, but be in absolutely no doubt, the PSR says that it expects firms to start work now on implementing the new requirement. And to help firms get a handle on what needs to be done, the PSR is holding a series of overview sessions next week. So if there is further information on the PSR's website and how to sign up to those. The government is also prioritising the development of policy that will allow firms to adopt a new risk-based approach to provide additional time for potentially fraudulent payments to be investigated. So this is particularly in relation to complex to solve cases such as romance scams and investment scams.
Okay, so we've titled the next slide rather dubiously "Benefits of the Current Regulatory Environment," but let's explain what we mean by this. Where does that leave the current sort of roster of UK regulation? What's the current position? And more importantly, what does this tell us about the direction of travel of current regulation, and what are the priorities? And once having established these priorities, can we see wider benefits of these priorities for us as firms in the payment industry? Arguably, the first is better protection. And I've split those into three. First benefit of the current priorities, as seen through consumer duty, and as Diane was explaining, the app scams, etc. There should be protection for consumers, whether through selling relevant products, protection for their money while the firm holds it, or compensation for it all if it all goes wrong. Secondly, market reputation. No one, I'm sure, needs to be reminded of the current reputation amongst the general public of the financial market in general, with the recent economic uncertainty, bank failures, and high-profile malpractices. There continues to be a headline-grabbing failures of payment firms through poor regulatory practice. How do the regulators and firms working together alleviate these reputational challenges? How do we collectively rebuild trust in the industry? Surely that's in everyone's interests. And thirdly, protections for you, the businesses, whether ensuring resilience in times of economic shocks, such as we're going through just now, and failures of key suppliers, critical threat vulnerabilities to IT systems, through to the management of liquidity, revenue, and capital. Linked, of course, to all of that is a rigorous approach to when it comes with dealing with the early identification, supervision, and ejection, I suppose, of bad faith actors. Only by exercising zero tolerance towards these firms will the reputation, which we mentioned earlier, start to build back to where it should be for the whole industry. All over the next one, all over the Dear CEO letter. It's a small phrase, but a phrase nevertheless, which the FCA take very seriously. That is financial prudence. This should be the acid test of everything that we do. No risk taking when it comes to other people's, our clients' money. There's a world of difference between innovation, I'm sure Diane would agree, and unwarranted risk, either through badly designed controls or by omission of controls. By adhering to regulations, sound financial risk management, and a functioning control environment, companies can lessen risk of major shocks to their clients, markets, and businesses. Whether it's through reviewing product lines or external funding, the regulator expects future planning. And that brings us to governance. We could all probably have myriad of ideas of what form governance should take and takes in our organizations. But at its basic level, it's about asking a simple question. Do I have, as a senior manager or board member, have all the required information to enable me to take decisions which will benefit my clients, my market, my business? There's no easy way out of asking and answering those questions. There are no shortcuts, if you like. But it can be as basic as, are all our safeguarding reconciliations completed in a day? To what would we do if our banking provider went out of business?
And I think we can all agree that credibility and trust are vital for any business, and even more so when it comes to, as David says, other people's money. And regulation really helps to establish this. But it also means that startups in particular can take a more mature approach to market, and growth for any firm, whether you're at startup stage or scaling up, is full of challenges, attracting capable leadership, attracting funding, ensuring financial stability, and so on. And the sooner firms get a handle on the regulatory requirements, the sooner they can go on to grow and thrive. And as I'm sure we all know, innovation creates lots of excitement, but also lots of hysteria, lots of suspicion, often in equal measure. And regulation really helps to cut through all of that, consumers will be asking themselves a number of questions before they even choose to use a product. For example, how safe is my money going to be? How will I be protected? What happens if something goes wrong? And will I get my money back if the company goes bust? The regulatory requirements, not least the safeguarding requirements, can provide legitimacy to your products and services because regulation breeds trust, and trust is ultimately one of the key factors behind a consumer choosing to use a product. And the consumer duty, as David has talked about, is a very clear example of how regulation can drive market confidence more broadly. High standards are, as the FCA puts it, necessary for healthy competition and innovation in consumers' interests. And we would hope that this is going to stimulate much more positive media coverage, disarm vocal critics as firms ramp up their quality for their customers.
So what does all of this regulation mean for your business? What does good look like? What are the expectations of the regulator, the client, and the market? We've talked about the benefits to the business, but let's talk about what the regulations are actually asking. We've put not an exhaustive list here together, but certainly one which I think captures the key points. Firstly, it takes investment in your management controls. What form that takes and how much it costs will obviously differ from company to company, but it does mean that proportionally you should have forms of internal controls which give assurance across your business, whether that's from the recording of transactions to the reconciliation systems you use, to the method of financial control and the requisite IT controls. Which moves us on rather effortlessly to the next one, and that's really the human element within your business. Do you have sufficiently qualified and experienced people who know how to run the business? And importantly, are you overly dependent on certain individuals who would given the turnover in the market as it currently stands, can leave your business with a fond farewell and a huge gap to fill? Likewise, does everyone within the company know what is being achieved, know what goes into servicing the clients on a daily basis? Is there a succession plan in place for key positions? Are management consistent and transparent in dealings both internally and externally? An example which could be used would be, how sure are you as senior managers that each one of your staff could spot fraudulent activity or take appropriate action in the event of a cyber attack? Next point is a need for regular review of the business, not just because the regulations say that an annual audit needs to be carried out, but you as custodians of the business need to have an independent view of the health of that business. I suppose it's really in someone like me's interest to extol the virtue of the independent consultancy or auditor. But whether it's regulatory or otherwise, regular external views on the business should be and can be used as a milestone on the health of the business. If an external review or audit is done well, then not only should it find faults within your business, but it should also place emphasis on recommendations and enhancements and be the start of a two-way relationship. Investment in lessons learned, training, and keeping up with regulations through horizon scanning must by design strengthen the business. Having a wider pool of knowledge and, dare I say it, growing your own talent must lessen flight risk, heighten resilience, and service your customer base efficiently. Likewise, dealing with regulatory bodies in a transparent and open way, and this isn't the only way to go. That's not always met with general approval, but it is the only way to go. In my experience, it's absolutely vital that if something does go wrong, the sooner the regulator knows, the more willing they are to respond in a positive way. Likewise, all of the elements above being present demonstrate to the regulator a picture of a well-run business. And of course, proper record keeping, which shows clearly the picture of a well-run business, is absolutely key to the previous point of when dealing with regulators. Have you kept proper records of due diligence, Or are your safeguarding reconciliations so complicated that it would take a rocket science to arrive at a daily liability? I've seen it in certain businesses. Do you complete regulatory returns in time? The list is endless, but it's another example where regulation meets a strong business. Lastly, on this not exhaustive list, as I say, are your systems, pardon me, and processes mapped and any vulnerabilities identified and tested? This is the whole underlying principle of operational resilience in a nutshell. What do you deliver to your clients, your important business services? How do you deliver them? Who helps you deliver them? Third parties, outsourcers. What are the weak points that we've identified in that delivery chain? Would this cause serious harm to my clients or the market if they weren't delivered? In summary, I've listed these as requirements of regulation, but I hope as we've gone through the list that you've ended up saying to yourself that, yes, this is actually almost common sense and almost a blueprint for our company. So we've talked about the benefits. We've talked about what the regulations force as a requirement within your company. We may be stating the obvious with this slide, but I don't think it harms our case in any way to lay out the stick part as well as the carrot. I'll let Diane spell out the first few points here.
Sure. So what do we mean by marketplace reputation? I guess at a high level, it's the excuse me, the beliefs and opinions that we have about a sector, for example. And as the saying goes, trust is hard to build, but it's actually very easy to lose. From a payments industry perspective, it only takes one or two bad players to tip the balance and change the way people feel about the sector. The Wirecard collapse is a case in point. The FCA immediately imposed restrictions on the UK business, which operated as a separate entity to Wirecard AG. And that cut off customers from their money, many of whom were vulnerable. It sent shockwaves right through the industry, and it raised some serious questions about the way the industry is regulated. And in those critical few days, the press was flooded with stories of people who couldn't pay their rents, they couldn't access child benefit payments, they couldn't top up their gas and electricity meters. Excuse me. The FCA was criticised for failing to look after consumers with, as the BBC reported at the time, their heavy-handed and inept approach. The safeguarding requirements were also called into question. And the market was spooked again earlier this year as problems mounted at Railsa. At a firm level, the consequences of overlooking the rules and regulations can be very severe. Poor practice erodes trust and can lead to consumers not trusting firms with their money. It's vitally important to stay on top of compliance, especially as a firm's product and services evolve. So firms need to think very carefully about, areas, for example, are you clear that you've identified if a new product has features that could potentially cause harm to vulnerable consumer groups? And when it comes to your marketing communications, are they clear? Are they comprehensive? And are they truthful? And are you confident that these communications do not give consumers misleading impressions, for example, describing e-money accounts as bank accounts when they're not? And have you made sure that your customers know how their money is protected?
Obviously, for serious infractions, there are serious penalties which go alongside it, but they can run from fines, compensations, right the way through to the ultimate sanction of legal prosecution. Particularly for serious financial crime incidents, those identified as having the duty and accountability are seriously on the hook for whatever may follow. Particular focus on anti-money laundering failings have dominated the year so far. However, safeguarding of client funds remains important, as the Premier FX incident in 2021 when client funds which should have been safeguarded were found to have been used for other purposes or other investments. Future areas of focus could well encompass failures in the consumer duty regulations and also operational resilience.
Yeah, and of course, the most serious consequence of poor practice is firm failure. Whether that's caused by inadequate funding or poor management, inadequate controls or oversight, breaches of the law or wrongdoing, the impact can't be underestimated.
Yeah, if there are any serious or repeat breach of regulations where shortcomings were either not uncovered or large reportable breaches not recorded, as it brings me back to the transparency point that I was making earlier on, then the FCA has opened to it many recourses to supervision through further returns or audits or both. So transparency is actually, key to the whole avoidance of these recourses. Ultimately, what we want to avoid is obviously the final sanction, that of your business failing, and all of what follows that. So, having looked through the benefits, looked through the requirements that they place, and looked through, if you like, the consequences of failure, what questions should you as a company and you as a senior manager be asking? What is the regulation forcing you as a company to consider?
And I think one of the first questions is, are your customers getting the best deal and are they protected? And we've talked about the consumer duty in some detail, but it does make it very clear that firms must put their customers' needs first. And this forces firms to dig deep and ask questions such as, are your customers given a genuine opportunity to see important information before they apply for a product? Are you giving them the information they need to make an informed choice? Customer support. Does your customer support enable your customers to fully utilize the products you provide? And are you confident that any exit fees that you charge are commensurate with the cost of the business of a customer closing their account? And connected with that, are you confident that there are no unreasonable barriers to account closure?
Yeah, from an internal point of view, the questions that I would come up with would be, is your company sufficiently resourced? Both from a human resources point, are they adequately trained? Do you have a succession in place? Do you have sufficient capital to meet the ongoing capital requirements? Are your revenues growing? Is your technology truly resilient? Have you tested them? Have you tested your systems? And more importantly, do you test them against plausible but severe scenarios? How often do you test them? What changes do you make as a result of the lessons learned, which is possibly the more important question? Do you truly monitor your third parties, your outsourcers? Do you challenge them on SLAs? Who's responsible for scrutinizing contracts that you award? Are they scrutinized by the board? Are they given approval? Is there a policy in place to gain approval? Do you have a realistic exit plan? Do you have a functioning wind down plan? More importantly, do you monitor the alerts and the indicators that are contained within it regularly? Does it reflect the actual shape of your business that you have now? Do the board review it regularly? Do you test it? And do you as senior management have functioning management information? Do you regularly discuss it? How does decision making function in your company? Really fundamental questions around your management information. What checks do you have in place when it comes to financial crime, safeguarding, all of that type of thing? Does your risk management, linked to that, does your risk management process bear any resemblance to the current business? Is it fit for purpose? Again, what changes are made when reviews are carried out? Have you tested them? And do you have backing and sufficient financial resourcing? Again, have you tested that? And does compliance monitoring cover in detail all of the risks within your company? Do you get to see the results? Do you get independent assurance? External reviews and audits are a vital component of the overall picture of the health of your company. How do you approach that assurance?
And linked to, all of these above points is, particularly if you're looking for funding, is do you know what investors are looking for? Fintechs are still among the most exciting opportunities for investors, but now more than ever before, they're looking for firms who can demonstrate a clear path to profitability. And when it comes to building business resilience, regulation should also make firms think about how they define success for their business. So is it the number of customers you have, or how your business compares to your competitors? And of course, success can be measured in all sorts of different ways, but whatever metrics a firm uses, it always needs to demonstrate profitability. Which brings us on to the future. We've touched on just some of the key policy areas, excuse me, and highlighted how regulation can be a true enabler of fintech success. As with most sectors, the payments sector isn't alone. It's been buffeted by a global pandemic, challenging economic conditions, skyrocketing costs, and in tandem with all of that, the growing expectations of regulators. And with the various regulatory proposals and requirements coming down the line, it can be really hard, tricky to know what course of action to take. But actually none of that matters if firms haven't thought about their operations, the structure of the business, who the firm serves, and on whose services the businesses depend. And it might sound obvious, but being proactive and identifying the potential risk to the business is absolutely vital in ensuring, that firms can embrace regulation, see it as an opportunity rather than a threat. I think ultimately it boils down to firms being alive to any new or heightened risk to the business, keeping a very watchful eye on key industry trends, and using all of the resources that the industry provides, whether that's your partners or your advisors or your industry bodies.
Thanks, Diane. Fscom produced a webinar back at the start of the year, surprisingly, which looked forward to key trends during 2023, key trends within the industry, many of which are a continuation of what we've discussed today, especially in the change of culture, which a lot of regulation trends are pointing towards, and the idea of a whole company attitude. Amongst the most important that we looked at was continued emphasis, obviously, on outcomes for consumers and protection of consumers contained within the consumer duty regulation. Enhanced scrutiny at the gateway. This means that the application will require much more preparation than may have previously been the case. Far more detailed question on all aspects of the application process, especially compliance with the regulation. Dear CEO letters, the frequency and content suggest a much more proactive approach to regulation. Companies need to prepare for this. For example, we expect safeguarding regulations to be subject to consultation imminently, and as a result, move much more in line with CAS. That's our opinion, obviously. ESG, investors and consumers are increasingly being driven by these factors. For example, diversity and inclusion policies, and in much more detailed scrutiny. No more greenwashing. Operational resilience and resilience in general, actually. Expect much more movement here. To date in the UK, it's been relatively self-addressed through the self-assessment documents, etc. I would expect that to become much more regulated. Crypto, which way will regulation go? Human resourcing, staffing appropriately for expansion. And increased complexity in financial crime over COVID and beyond, and increasingly greater threats. The regulation will have to match that.
Thank you, David. I think before we wrap up, we do have a little time for questions, and I can see that we've got some questions here. So the first question I can answer, is it possible to get a copy of the slides? Absolutely, yes. There will be a playback as well. So that will be available certainly on our website. So we will let you know when that's posted. This is one for you potentially, David. Are digital currencies expected to surpass cash transactions? What do we think?
I think if I had the answer to that, I wouldn't be sitting here. To be quite honest with you, it seems like every day there are conflicting stories. I actually read one today on the BBC website. I don't know if anybody watched it, where it asked the question, was the US trying to kill off digital currencies and crypto? So I think possibly in years to come, possibly, particularly with central bank digital currencies, but it's a long and rocky path, I think, would be the answer that I would give to that.
Okay. And another question here: how do you debate regs that are considered overbearing and conflictist? So, I mean, from our perspective as an industry body, excuse me, if we feel that in a regulatory consultation, for example, whether that's the FCA or the PSR or indeed Treasury, if we feel that some of the proposals are likely to be disadvantageous, or it could hinder innovation, or it could make it very difficult for new entrants to come into the market, then our usual process is to put forward a cogently argued a case with evidence to back that up in our responses to regulatory consultations. We also have regular engagement, particularly with the FCA, and again, that's an opportunity for us to put forward a case for potentially more proportionate regulation.
And of course, a lot would depend on who and how you considered certain regulations overbearing and conflictist, and that would differ greatly.
Absolutely. So there are no further questions that I can see. So that just leaves me to say thank you all so much for joining us today. I really hope that we have given you some food for thought. You can also reach out to us directly. I've popped our email addresses there on the screen. So many thanks from me.
And thank you as well from me.